This is why you need to take this information that you get here and make sure that you're working with a qualified accountant that understands it. Welcome in everybody to REI Tax University, where we help real estate investors and professionals save more of their own money, keep more of their own money, and grow their wealth and portfolios by paying less taxes. And they do that by utilizing their real estate investments and activities. Guys, today I want to talk about 5 ways that you can use your passive losses to offset all of your active income. So let's jump in here. All right, the 5 top ways to do this are meet reps, 2, spousal reps, 3, short-term rental loophole, STR loophole, 4, use PIGs, passive income generators, and 5, consider shifting your active income to be passive income. Now let's run through each one and how to implement it. So the first one, and probably the most well-known, is reps, real estate professional status. So the key to reps is if you meet it, you can take any losses from real estate activities, from your passive investments, and you can offset any of your active income. So your W-2 income, your business income, you can offset all this income. If you got retirement distributions that are taxable, it can all be offset by the losses from your rental activities or your other real estate businesses. So how do you do it? There's a lot of misconceptions of, I don't have my realtor license, I can't do it, I don't have this license. You don't need any license. There's 2 key rules that the IRS needs you to do. You have to work at least 750 hours in qualified real estate activities. And the second is those qualified real estate activities have to be what you do with over half of your serviceable time. So what that means is you have to do it at least about 15 hours a week in the year. And the second rule is you basically can't have another full-time job. If you have another part-time job, you need to make sure that you're working more hours in the real estate stuff than you're doing in that part-time job. Now, when you're talking about those real estate hours, the other thing to note here is that in general, they can't be W-2 type hours. So unless you own 5% or more of the business that you're working in, then those W-2 hours aren't going to count. So if you're in a business and you're working for a W-2 company as a realtor or acquiring property or property management, those hours aren't going to count. Those are going to be your actual separate job. They're going to count against you. So you've got to make sure that the hours are going to count. And then the last thing is you're going to need to keep your log for this. So I know a lot of people don't love doing that. I know it's meticulous, but you really do need a log to say, okay, this is how many hours that I'm working in real estate. If you do have another job, part-time or full-time, you want to have something to document how many hours are worked in that job too, because that's what they're going to ask you for if they want more information from you, is they're going to say, hey, where's your log for real estate? Number one question they're going to ask if you go under an audit. Where's your log? They'll give you that, and then they'll say, okay, we see you have a part-time W-2 job. How many hours did you work in that? Now, the nice thing is you can probably justify that with a pay stub, with something like that. But if that pay stub shows, oh, you worked 1,000 hours, they need to see on your real estate reps log that you met at least 1,000 hours, right? So you need to have that log. But meet these reps rules and you can, again, open the floodgates. You can take your losses. You can offset active income. So number 2, this comes up a lot of times. This is the spousal reps. So in this instance, you didn't meet one of those reps rules as one spouse. So maybe the husband has a full-time W-2 job. He can't meet it, right? Because if you have that full-time W-2 job, it's going to be very difficult to meet it. Almost impossible. I typically don't even advise our clients go after it because they will not believe you if you try to tell them that you met it with a full-time W-2 job. So the alternative here becomes if one spouse can qualify for reps, then both spouses qualify. Meaning, if the husband has a W-2 job or runs a full-time non-real estate business and the wife works part-time, doesn't have a job, or works in real estate as a non-W-2 person, maybe a realtor that gets commissions or something like that, that wife could meet real estate professional status. She can meet the 750 hours and the more than what she does with her time, right? And in that, she can take all the real estate investment losses. She can take any losses from the real estate business activities and offset that husband's active income, all the W-2 income, and all any business income that he might have, or non-real estate income, any retirement distribution. So if one spouse qualifies, you both qualify. So again, that's a big one. It comes up a lot of times. Now that spouse that's going to meet it, they have to be the one working the hours. So if husband's working full-time W-2, he's doing all the work in real estate, you're not going to meet it. But you might want to talk to the wife or vice versa. If the wife's doing all the work and needs the husband to meet it, right? One of the spouses needs to meet it, and you need to make sure it's the one that isn't doing over half their time at another W-2 job, right? So they can meet it. You can utilize it to offset all your passive losses, or to use all your passive losses to offset your active income. Now, the third way here is called the short-term rental loophole, the STR loophole. And what that says is if the average stay at the property that you own, your investment property, is 7 days or less, then you don't need to meet reps, right? You don't need to meet reps. Your spouse doesn't need to meet reps in order to take all the losses from those activities and offset your active income, your W-2 income, your business income, any of that. So all you need to do is materially participate in the short-term rental. And materially participating is a lot easier than meeting reps. To materially participate, you probably either need to work at least 100 hours and more than anyone else in the property. That pretty much means you don't have a property management company, you manage it yourself that year, or you need to work at least 500 hours in the property. And now for reps, when we're talking about that, it's spouse by spouse. If wife does this, that's her hours. If husband does this, that's his hours. When we're talking about the short-term rental loophole, the spouse's hours are actually combined. If husband works 200, wife works 100, that's 300, right? So we're trying to get to 500 hours. And that's how you're doing it, is by combining the spouse's hours, and you're, again, trying to get to 500, or if you don't have anyone else working in the property or working significantly in it, you can utilize that 100 hours and more than anyone else. There's a few other rules you can meet here, but those are the two big ones. And if you meet those, you can take all the losses from the short term, offset all of your W-2 active income, right? All of your business income. So the short-term rental loophole, it's kind of called the W-2 guys, like his loophole, right? Because you work something else, you can't meet reps, your spouse works, they can't meet reps. So you start to get into short-term rentals. Now the next one is something called PIGs, passive income generators. So if you have real estate investments, they are likely, or especially if they're early on in those investments, matured investments can change and they can start to generate some income. But if you're early on in your real estate investments, they're likely going to be kicking off some passive losses for you. And if you're earning enough in W-2 income, if you're earning over $150,000 between spouses, like, you're not going to be able to use those losses if you don't meet reps, if you don't meet short-term rental loopholes. So your spouse doesn't meet rep. What you need to do is look into, well, could we create passive income? Because those passive losses can offset passive income. They just can't offset active. So to create passive income, you look for things called PIGs, passive income generators. Now, if you have a financial advisor, this is the time to talk with them and to really figure out if they know what they're doing and if they're a good one. Because you're going to say, hey, what can we do to create passive income? What can we do to get PIGs? I've got passive losses that I'm going to be sitting on. I know I can accelerate. I know I can get those passive losses even higher if I want to. So what opportunities do we have to get passive income? So now we're talking about things like investing into businesses, investing into REITs, investing into more matured real estate structures where it's kicking off income. Because what we're looking for here is income and cash flow from these investments, right? So private equity funds is another one. There's a lot of these dividend producing things. So you're not reducing your dollars in taxes, but what you're doing is you're creating more income. You're getting quarterly payouts or monthly payouts. You're getting income from these investments, and you're not having to pay taxes on that income because you're offsetting it. So what you're doing is earning more income, but not paying additional taxes. You're lowering your effective tax rate, your average tax rate, because you've got more income, but you're not paying tax on it. So you weren't able to lower your taxes, but you were able to create more income without it being taxable. Now, the fifth strategy here, which gets pretty creative, and I don't hear of this a lot, but we have seen it happen. We have helped clients do it. This is called shifting active income to passive income, right? So what we're talking about here is you got to start to look at things backwards. So what you're usually looking at is, how do I get my passive losses to be active losses, right? How do I get those meet reps and get those passive losses over here? But in this case, what we're looking at is actually the opposite way. Is we have active income and we have passive losses. What if we could make that active income passive income? And it comes over here and we use those losses to eat it up and we lower our active income over here, right? So how would you do this? Well, let's say you're running a business, and let's just say this business it's a cleaning business. You do commercial cleaning, you do residential cleaning, and you own the business. It's one entity that you've set up, and all an entity is a set of activities that you decided to call one entity. It could be 5 entities if you wanted it to be. You could break it off and, hey, this one does this type of cleaning, this one does this type of cleaning, this one does this stuff, right? But you've called it one entity. So in this case, let's say that cleaning company that you're actively working in makes $1 million in taxable income. It flows through to you this year. And then let's say you have a real estate investment, and that's $200,000 in losses that you have from it this year. You're like, hey, we used a cost segregation, we've got our depreciation, we've got our mortgage interest, we've got all our other deductions, and we're at $200,000 in loss. Well, normally we're going to put that on your tax return. You're going to have $1 million in active income, $200,000 in passive loss, but we can't use it because you didn't meet reps, your wife didn't meet reps, there's no short-term rental loophole, or, we're not talking about self-rentals right now. So, but let's say you get creative here and you take that entity that made $1 million and you're like, well, what else does this entity do? Well, we do commercial cleaning, we do residential cleaning, you break it up. You're like, okay, well, the residential stuff makes us $200,000 bottom line, and the commercial stuff makes us $800,000 bottom line. And as the owner, I do most of my work in the commercial stuff. I already pretty much have another manager who does the residential. I could replace myself. I don't really need to do a lot of work over there. So we create a new entity. That new entity is just for the residential work, and the one that you've owned previously is for your commercial work. You're actively working in that commercial work because that's what you do. You ensure that you don't materially participate in the passive one that you created, the residential work. And so what you've done is you have 2 entities. The commercial one makes $800,000 in active income. The residential one, you passively own it. You're not doing a lot of the work in that one. So it makes $200,000, right? So that's your $1 million. Now it's broken up, 800, 200. And then you have your real estate investment that had a $200,000 loss on paper. So what you've done is you've got, let's look at it now, you've got 800,000 from the active side over here. And then on the passive side, you have 200,000 of income from the residential business that you broke off, and you have 200,000 in losses from your real estate. That's going to wipe each other out, be zero, and you're paying tax on $800,000. So what you just did was removed $200,000 of taxable income by doing this strategy. Again, it gets pretty complex. Definitely need to be working with an attorney, an accountant, everyone that knows what they're doing when you do this. You need to make sure you're failing the material participation to do this, but you can definitely do it. You can shift active to passive just the same as you can shift passive to active, but you need to make sure know what you're doing. You need to make sure K1s and things are marked appropriately, tax returns are filed appropriately. This is why you need to take this information that you get here and make sure that you're working with a qualified accountant that understands it. Make sure if they need educated on it, you're educating them on it and making sure they understand it and know how it needs to be reported. Guys, I hope you learned something here. I hope you can take some of this information, and if you haven't been using these losses, these passive losses to offset your active income, hopefully one of these strategies can work for you either now or in the future, but at least you're more equipped to know this is how and when I can utilize that real estate, those passive losses to offset my active income, right? I see it all the time where clients could be doing it and they aren't, or they just don't understand how to do it and how they can get there in the future. So guys, thank you for joining here today. I thank you for following along. If you like this content, if it's valuable to you, jump over to REI Tax University. REITaxU.com. It's a community where we help real estate investors and professionals understand everything they need to know for tax planning and how to utilize their real estate to reduce their taxes. Jump over there, join the membership community, get active in the forums with us, guys. And we really appreciate you watching these videos and following along. And we just want to help you as much as possible. We want to help as many real estate investors and professionals as possible, guys. Thanks for watching.